Hello, everybody. I'm Ben Graham. This is our third lecture on foreign investment in our International Political Economy course. And the focus today is going to be on foreign direct investment and development. Sort of the good, the bad, the ugly. But we're going to start with this piece of sort of what is it that gives multinational firms a competitive edge, right? So we're in this sort of foreign investment module where we've been talking about portfolio investment, where you essentially like own some stocks or something. You don't own a controlling stake. You don't actually control the enterprise you're investing in. So either you own a stock or you own a bond, right, which is just a loan to a company, but you don't actually control what that company does. And then foreign direct investment, which we're talking about today, right, and we were talking about more in the political risk context, this is direct ownership. This is controlling part, you own enough of the enterprise that you're actually involved in decision making in what that enterprise does. Really the archetype here in foreign direct investment is a multinational firm that sets up a foreign affiliate overseas, right? So what types of firms are capable of doing that? And there's a general model in economics which suggests that, that if we take as a given that investing overseas is difficult, right? That there are a lot of fixed costs associated with doing that. What falls out of that in terms of implications is that the least competitive firms in a market that are the ones that are just barely able to survive, they serve only the domestic market. The next most competitive firms are able not just to serve the domestic market, but also to export and to deal with the costs of entering foreign markets via trade, right? And then the most competitive firms are able to actually establish overseas subsidiaries in foreign markets, right? So that's kind of that comes out of a game theoretic model, but it's been tested quite a bit empirically, and that seems to be the case, that multinational firms are unusually efficient firms, right? That the only firms that are able to set up affiliates overseas and survive operating in multiple contexts are firms that are essentially really good at what they do, right? So to be able to survive as a foreign affiliate, to be able to like be an American firm and go set up an operation in Peru or set up an operation in South Africa and have that foreign operation be profitable, you've got to be better than the local competition on at least one important dimension, right? And the reason you have to be better, not just as good as, but better, is that you face a variety of challenges that we sort of lump together under this term of the liability of foreignness, right? That your home office tends to lack the language skills, lack the cultural familiarity, lack membership in the relevant social networks in the country that you're going and investing in. There are a lot of kind of built-in advantages that domestic firms have over foreign competitors. That belonging to the right social networks, particularly important in countries with sort of relatively weak formal political institutions. In that context, informal institutions are even more important. By informal institutions, we're often talking about social ties and social networks, right? And those networks provide you access to information. They help you enforce contracts. So this is the idea that, okay, if I deliver a shipment of goods to somebody and they write me a check and the check bounces, maybe going through the court system to collect on that check, maybe that takes a long time and it's super expensive. But if I put in a phone call to everybody else this person does business with, I may be able to shame them into paying me back, even if I can't legally force them to do it. So I can use social enforcement to substitute in for some of the formal, legal political mechanisms. Right? Okay. So how is it that multinational firms kind of overcome this liability of foreignness? What are the advantages that they bring to the table that make up for not having sort of those built-in domestic advantages, for not being local? And some of this is that they possess unique knowledge, whether that's technology or particular types of management expertise. They may also possess economies of scale, that often just being big allows you to produce things more efficiently, right? If your factory is turning out 1 million widgets, your cost per widget may be cheaper than if you are an owner of a much smaller factory producing 1,000 widgets a year. That per unit cost is likely to be higher in the smaller operation. So if you're in an industry that has high economies of scale, an industry where it's much more efficient to be a big producer, then these big multinationals have this built-in advantage. Okay. So usually multinationals, their advantage comes in sort of one of those flavors, sort of economies of scale or particular knowledge, expertise. All right. So that's kind of a little bit about like what enables multinationals to operate effectively. And that idea that multinationals have unique knowledge and unique sort of skills or technology, right? That idea is linked to one of the reasons why we think that they, linked to sort of some of the reasons why they can bring some good things to the table in terms of development, that they bring in that knowledge and that expertise and that technology when they come. So part of what they're doing is they're coming in usually with more capital, right? So multinational firms come in with a lot of capital. And because they are pairing each worker with a significant amount of capital, they tend to pay higher wages than domestic firms, right? And there's pretty good empirical evidence that sort of holding industry constant, holding a lot of other things constant, multinationals, even when we're not just talking about their expatriate workers, but we're talking about the foreign nationals that they're hiring in their overseas affiliates, those workers are getting higher wages on average than the same workers would be getting if they're hired by domestic firms. So they tend to be paying higher wages. That's good for development, right? But the big piece that when we think about, well, why is it that developing country governments are super eager to attract foreign investment, right? When we talk about the race to the bottom and the idea that developing countries may be cutting environmental regulations or cutting labor regulations in a desire to attract multinationals, why is it they want so badly to attract multinationals? A big piece of this is that they're hoping for positive spillovers. They're hoping that local firms can learn from foreign firms, right? That these foreign firms are going to come in with unique technology, unique expertise, unique knowledge. One second. Sorry. Recording these videos with kids at home, it's creative. So how does this knowledge spill over? So multinational comes in, they have all this expertise, they kind of want to keep it to themselves. How does it end up diffusing out to other firms in the economy? So some of this is that local firms are learning from the foreign firms that are around them just due to demonstration effects and competition effects. So they have to compete with these multinationals, so they're looking and seeing what they're doing, and they're trying to emulate it, right? So that's sort of the demonstration idea. They see what the multinational is doing, and they try to emulate it themselves so that they can compete and keep up. But it's also the case that workers move back and forth across firms. So an individual might be hired by the foreign firm and work for the multinational for a while, and then they leave that position and they go take a position at a domestic firm. And they bring all that knowledge that they gained at the foreign firm and they bring it over to the local firm. And so knowledge diffuses when people move. And that's a key idea to like hold in your mind for the migration section of this class as well, is that if you want ideas to move, generally moving people is the most effective way to move ideas. And it's remarkable how really valuable information that seems like it should travel and diffuse really fast tends not to travel until people move. If you want ideas to move, people need to move. So when people move across firms, they tend to bring a lot of knowledge with them. So that's a key mechanism for knowledge diffusing from a multinational firm to local firms, is if there's an exchange of employees where somebody leaves a position at the multinational, goes to work for that domestic firm. And then there are some sort of more conscious steps that developing country governments or governments in any country that's attracting FDI sometimes take to increase the rate of knowledge spillover, right? And the most sort of the archetypal strategy here is to mandate joint venture partnerships. To say, okay, we will allow multinationals to come invest in this sector, but only if they partner with a domestic firm. And the reason you force the foreign firm to partner with a domestic firm is that you want knowledge to spread from the foreign firm to their domestic partner. And sometimes there's even explicit technology transfer provisions that are very detailed about the type of information and technology that has to be transferred from the multinational to the local partner, kind of like what that division needs to be. And the whole idea behind this is we don't just want the foreign capital to come in, we want the ideas and the technology to diffuse. And that's going to maximize the growth effects, the positive growth effects of foreign direct investment. Okay, so that's the upside, right? And here's just a little bit of, I pulled this out of an economics textbook. It's probably about 10 years old. But you'll see that like in general, across the world in both high income countries, so like in the US and the EU and in Japan and South Korea and places like this, even within high income countries, multinational firms, which again tend to be those most competitive firms in the country, pay higher wages than the purely domestic firms, right? Which tend to be the less competitive firms who aren't competitive enough to be able to become multinationals themselves, right? And so these more competitive firms tend to pay higher wages, even if you're in a high income context. But in a high income context, they're paying about 40% higher wages, which is big, that's a lot. But if you look at in low income countries, the multinationals are paying double what the domestic firms are paying. Like I said, this data is about a decade out of date, but this gives you kind of a sense that like these are not small differences. When you have multinationals coming in, bringing a lot of capital with them, they are creating jobs, and these on average, these are very high paying jobs relative to sort of jobs doing the same work in the same industries at domestic firms. So there's some very good reasons that that governments around the world, and particularly developing country governments, are very eager to attract foreign direct investment. And so we'll sort of talk about like what some of these trade-offs look like from the multinational, the perspective of a multinational firm. And we'll use the case of GE entering China because China was pretty aggressive, particularly in this case, but in a lot of cases, in using these technology transfer provisions and the joint venture requirements to try to make sure that the foreign investment they're attracting is generating long-run economic growth and technology transfer for China, right? And so essentially the Chinese government cut a deal with GE where they said, okay, you can enter our market, you can come set up affiliates, and you can sell power generating equipment to all these new power plants that we're building. But in order to sell in our market, you need to build these things here, and you need to do it in a joint venture agreement with a Chinese state-owned company, right? And you have to share some of this technology, right? So they forced GE into a joint venture agreement. They put explicit technology transfer around that. And what GE is doing is they're making a trade-off. Like China's this huge market, so much of the new power construction, I think this was done in the early 2000s. And so much of the new power, sort of new power generation, so many of the new power plants that were going to be built in the world over the next couple of decades were going to be built in China. GE really did not want to miss out on that market. But to get that market, they had to make a gamble that they could have a lot of sales now, but they were going to end up with more competition later, right? They weren't dumb. They knew that China's goal here was to develop their domestic capacity to be able to compete with GE, and not just compete with GE in China, but compete with GE globally as a provider of these turbines and other power generation equipment, right? And so GE took this gamble and got a lot of sales out of it, this sort of thing. Actually, within the last couple of years, there's been a legal case around corporate espionage and spying to get additional technology from GE related to power turbines. So if you want to do some reading about corporate espionage and sort of the geopolitics of technology transfer and technology theft, the GE power generation case actually continues to be quite salient. But this is, this is China working to have foreign investment generate growth for them. And GE's trying to figure out how do we retain our technological edge and continue to make profits in the long run. And they're squaring off against each other in some legal ways. And then as you'll see if you kind of read the court dockets on some of this stuff, or probably more enjoyably the news coverage around it, some illegal ways as well that struggle has been carried out. Okay. So there are some real positive effects of foreign direct investment on growth through these knowledge spillovers, through the higher wages. We're bringing capital into a capital scarce economy. What could possibly be bad about that, right? But turns out there are also some major downsides to this that can be manifest. So some of this is sovereignty concerns. You're bringing in some very powerful actors that then have strong political preferences and throw their weight around politically. And sometimes they're doing that in ways that normatively we might approve of, and we might talk about them as civil society actors and advocating for clean governance and efficient regulation and things that we might think are kind of normatively okay, that they're sort of participating as an interest group in politics. But there's also a long history of multinationals doing things that are go well beyond, I think, what normatively we would think of as sort of interest group participation in a democratic context. So if you look at the case of, and the CIA was very heavily involved in the overthrow of Salvador Allende in Chile. He was a democratically elected leader, but he was a leftist, and he was going to nationalize a bunch of multinational assets, and he was taking the whole country sort of toward the left during the Cold War. So we were, so the United States viewed that as against our national interest. But a number of the multinational firms, including most prominently International Telephone and Telegraph, had very explicit economic interests that were going to be harmed by an Allende administration. And ITT was very involved with the CIA in orchestrating the overthrow of Salvador Allende, and Allende was murdered during that overthrow, right? So you know, we sponsored, the United States sponsored a coup, but our American-based multinationals were deeply involved in that, and not everything has been declassified of those operations. So we know that the CIA was deeply involved. We know that ITT was deeply involved. We still don't know the full details of everything that they did. There was somewhat more recently, still a while back, but somewhat more recently, there was a United Brands case in Honduras where this was just like straight up quid pro quo cash corruption, a $1.25 million bribe paid to the president of Honduras to get rid of a banana export tax, right? Just straight up corruption. Right. So you have these multinationals that come in and throw their weight around, again, maybe in some cases sort of legitimately as interest group participants in civil society, and sometimes much less legitimately, but in ways that may benefit the multinational at the expense of, say, the average citizen in the countries that they're investing in. Right. And we talked about, sort of when we were discussing neocolonialism, this sort of broad idea that powerful multinationals can extract deals sometimes that benefit the multinational a lot and don't do a lot for the national interest of the country in which they're investing in. So, you know, multinationals as policy actors may drive sort of the race to the bottom, right? Maybe pursuing lax regulations, maybe getting tax breaks that are really more generous than they ought to get. They may be getting away with labor rights violations and labor repression. And I'll note that this sort of idea of multinational firms getting over generous tax breaks and land usage rights and these kind of things, this isn't unique to developing countries, right? We have this concern in the United States too, right? So, you know, look into some of the things that various, you know, Louisiana and Mississippi and these states were doing to compete for plants by Honda and other foreign automakers, right? So Michigan is competing to attract them, and they're saying, hey, we've got the auto workforce, we have the whole supply chains for all the parts distributors, and the southern states are saying, hey, we have weaker union rules, right? They're competing in straight race to the bottom, sort of low labor regulation sort of stuff, and they're offering generous tax breaks. Michigan's offering tax breaks. You've got these different US states competing with each other to offer tax breaks, to promise that they'll make it difficult to unionize, right? To attract these big factories, right? And so this is not just unique to developing countries. This happens, you know, in the US context as well. In general, right? When multinationals come in, they bring a lot of jobs, they bring a lot of tax revenue, and they bring good paying jobs, right? Okay, well, that puts the multinational in a powerful position to extract concessions from elected politicians, right? And how much is too much for them to offer, right? How much of a tax break is appropriate to offer? Is it okay to weaken union regulations in order to attract more employers who are going to bring more jobs, right? You know, it's not clear what the right amount of incentives is, but these are difficult things that kind of investment host countries, including the United States, has to wrestle with. We generally think of the United States, I think, like as a foreign investor. We think of US multinationals doing business around the world, and they do. But the US also attracts a lot of inward investment, right? And US localities compete over that inward investment and compete to land those factories and other sorts of things. Okay. So one of the pieces of legislation that's on the table to deal, you know, really specifically with things like the United Brands case but a little bit more broadly, kind of the use of corruption as a tool by multinationals to extract cushy deals from governments, is the Foreign Corrupt Practices Act, which is a really unique piece of legislation in the United States because it makes it a crime, a violation of American law, punishable by US criminal courts. So arrested by US cops, held at a US jail, tried in a US court, right? For an American company or any representative of an American company, and any foreign-owned company that's traded publicly in the US, it's traded on the New York Stock Exchange, makes it a crime, a violation of American law for them to bribe foreign officials, right? By and large, if the act you are committing takes place in a foreign jurisdiction, US law doesn't have anything to say about what you do, right? So if you fly to another country and you go rob a store and walk out, with goods that don't belong to you, you haven't broken US law. If you go shoplifting in France, right? Or even if you hold somebody up at gunpoint in France, you're not breaking US law. When you do it, you're breaking French law. But this is saying if you pay a bribe to somebody in France, or if you pay a bribe to someone in Peru or in South Africa or anywhere else, and you're doing that on behalf of an American-owned company or a company that's traded on the US Stock Exchange, then you have broken American law, and you can be arrested and extradited and tried in US courts, right? And this also covers actions that are taken by a foreign partner on behalf of an American firm or a firm traded on the US Stock Exchange. So the upsides of this, I think, are pretty straightforward, right? We say, look, it's as Americans, as the United States government, we think it's morally problematic that US-based multinationals might be going around the world undermining democracy and paying bribes and engaging in this kind of behavior. We want it stopped, so we make it illegal. Okay. The downside to that, and what sort of folks will argue if they're opposing this law, is they'll say, look, in a lot of places, like, that's how contracting is done. You don't pay a bribe, you don't get a contract, right? And if you prevent US-based multinationals from paying any kind of bribes at all, then you're just preventing them from getting contracts, and they'll just be outcompeted by firms from Western Europe and firms from China and firms from Russia and firms from everywhere else, right? And you especially hear this argument right now saying that, hey, if we don't allow US firms to play a little bit fast and loose with this stuff, then we're just giving up contracts to Chinese multinationals, because the Chinese multinationals are going to pay the bribes. That's not a violation of Chinese law. And so, they're going to do it, we're not going to do it, and then they'll just have the whole market share. And you haven't reduced corruption, you've just kept American firms out of these markets. So that's sort of the counter argument that will get made. But this is American law, it's on the books, it's enforced, it is enforced with varying stringency by different administrations, but a lot of prosecutions have been brought under this act. Okay, so that's what we're going to wrap up. You'll notice that one of the paper topics that you can write about is what you think of the Foreign Corrupt Practices Act and how it might be improved if you were to try to improve it. Yeah, thank you very much for being with me, and I will see you in the in-person portion of our class.